Good afternoon to everyone, and I welcome you all to this budget series webinar presented by Grant Thornton Bharat. My name is Neeraj Sharma, and I'll be the moderator for this session today. Uh, we are extremely lucky to have such a rich panel of experts among ourselves. And before we begin, let me just quickly introduce the panel to all of you. We've got Vikas Vadhavan. Vikas is the Group CFO of PropTiger Housing and Makaan.com, a chartered accountant by qualification with almost 20 years of experience. Vikas has been focusing on fundraise, capital structuring, financial planning and analysis, and also leads the investor relations. You would have seen Vikas, a very prolific speaker on the topical areas of real estate. Thank you, Vikas.
Thanks, Neeraj.
We have Arvind Maya. Arvind is the CFO of Embassy REIT, again a chartered accountant by qualification with almost 20 years of experience. Arvind has been focusing on finance, compliance, risk management, uh, has been a real estate specialist focusing on the commercial real estate. He has been part of certain marquee capital raise in that segment of real estate. Thank you, Arvind, for joining
Thanks,
us.
Neeraj. Thanks for the opportunity.
Also have Mr. Sunil Ralan. Mr. Ralan is the chairman and managing director of J Mata Di Free Trade Zone, SEZ, based out in Chennai. Himself, Sunil has been the SEZ expert and working very closely with the government on the policy areas. Welcome, Sunil.
Thank you, Neeraj.
We've got Padmpriya. Padmpriya is a partner with Grant Thornton Bharat. She's been, focusing on the infrastructure sector, working very closely with the government, both at the center and the state level. Almost with 20 years plus of experience with the public sector consulting with Grant Thornton Bharat.
Thank you, Neeraj.
Thank you, Padma. Welcome to the panel. Last but not the least, we got Sumit Abrol. Sumit is a partner and leads the lead advisory for Grant Thornton Bharat. He's been a veteran on the deal making side with almost 20 years of experience. Glad to have you, Sumit, on the panel.
Thank you, Neeraj, and good afternoon, everybody. Welcome to all the other co-panelists as well.
Before we begin, let me just give a quick context for this discussion. A couple of days back, our honorable FM presented the budget. There have been a lot of discussions, reactions in last couple of days. There's been a strong push given to the infrastructure sector. On an overall basis, the budget has been hailed as a very well balanced budget. Have got very strong focus on certain strong pillars which are likely to push economy to a very fast trajectory in the times to come. We also heard the FM talking about the mission for housing for all, a large outlay towards that as well. There was also a discussion around creating centers of excellence to focus on urban planning so that mega cities are created in future. We also heard about giving data centers as an infrastructure status, which is likely to push both the commercial and also the digital India agenda of the government. I think we'll have some of our experts deep dive into some of these announcements and give us their insight on what are these announcements really mean for the economy as a whole. And let me just start with Padpriya, you first, and I'm sure you and some of your clients would be very happy to see the large outlay that the infrastructure sector has seen. The numbers are extremely significant. There's been a significant increase from the last year. I think the number is somewhere around the increase is around 35% as compared to last year. So just take us through what all these developments mean for the infrastructure as a whole. There has been discussion around 7 engines being as part of the PM Gati Shakti project, and how does that significantly impact the things on the ground, and also uh, impact the other sectors to really push the economy to the next level.
Thank you, Neeraj. And I think it's very important you raised on this part on, what can be the benefits for this announcement to the overall sector. So we all recognize that economy is driven by several factors, and infrastructure is been a very prime mover in the whole, movement of economic growth. And even when the world was reeling under the pandemic, the government of India has been specifically looking at this sector very closely and have year on year given an increase in the capital expenditure. So if you see, just as much as our GT's budget expectations were there, and it's proved us right that about 35% increase has happened from the last year's to this year's capital expenditure budget, pegging it up to about 7.7 crores, 7 lakh crores of rupees. Now, when you look at all of these, and there's always a common tendency to identify, like, given so many sectors, why is the government looking at infrastructure and giving so much of a push? Purely, I would say that, the government recognizes this as a multiplier effect. And let's just step back and see how this multiplier effect is actually going to span out for us. Increased public investment is a measure for readying India for India 100. And that's what is the theme under which all of this is happening. And Gati Shakti and the National Infrastructure Pipeline together are supposed to drive this. And that's the reason she had mentioned about the 7 engines of growth, which are all the important sectors of infrastructure. Now, the multiplier effect, as per the RBI as well as NIPFP estimates, somewhere around 2.5 to 3.5x. Now, what does that mean? It means for that every 1 rupee of capital expenditure spent on creating infrastructure for the country, the GDP gains worth 2.5 to 3.5 accrue. That's what it ultimately means. So to me, although there are several factors, I would like to pick on the top 3 important activities which will actually drive the infrastructure sector in the multiplier effect, and how are we going to see it. The first thing is on job creation. We all understand that, increased thrust to infrastructure development is definitely going to increase jobs, especially in the construction sector, raw material supply sector, supply of other materials, services, and all other, even including small and medium scale industries. Now, when this happens, naturally, there will be an increase in the job creation. Second thing, there's a lot of thrust being given to urban development. Now, through urban reforms and urban development, they want a proper development to happen at a regional level also. That again is going to increase the demand for the existing job seekers as well as the existing job who already have jobs. So the demand is going to increase, and also labor will naturally increase. Now, when I say why will naturally labor increase, it's because of these factors. Let me call it out for you. Addition of 25,000 kilometers of roads, multimodal logistics park at 4 locations, new products and services through the rail network, which will directly impact the farmers as well as the SME segment. 2,000 kilometers of additional rail network, 400 new gen trains, 100 Gati Shakti logistic facilities, and also implementation of 8 ropeway projects. Now, these are all, just see the mammoth investment which will go into each of this, which will lead to job creation. More importantly, they are also emphasizing on bringing in innovation in technology, which will again promote entrepreneurship, and the focus on youth is also being given there, right? So this is on job creation. Now coming to productivity. Now, the very sheer increase of these projects which the economy will see can be taken through increased capex, and also they will immediately contribute to the growth of the construction companies, raw material suppliers, equipment suppliers, labor force, etc. Now, they're also wanting to improve connectivity to reduce the cycle time also. That is the whole objective, right? So when logistics improves, goods and people can move faster and productivity will also increase. So the cycle time is also going to reduce. Now, this is one important factor on productivity. And the last one I would like to talk about, and a very significant one, which probably many of them are missing out, is on the procedural aspects. So you must be aware that in the last 2 months back, the public procurement procedures were eased up, wherein, speedy implementation of projects means then speedy approvals of the bills of all of these contractors, which means that they will have more working capital and their working capital crunch will ease up. So because of that, the procedures also added. Today, many of the construction companies are stuck with government projects mainly because of lack of money, lack of thing. So these are the three important areas, according to me, are going to help in creating that multiplier effect, Neeraj.
Okay. No, well said, Priya. I think you touched upon job creation, which is, anyway, a very, very critical piece that, that everybody is looking forward to. And I think your point on enhancing the productivity and connectivity is also very important, which is also likely to, improve the entire supply chain issue that we have been facing. And I can also foresee that you will be getting very, very busy now with some of these things start impacting the ground, and you also start picking up some of these things with your clients. So let me just change gears here, and the natural inclination moving to real estate when we are talking about the overall development and urban planning, etc. I think we also saw announcement around affordable housing. And Vikas, if I can come to you now, and I know your company tracks the sales numbers, the demand numbers across India very, very accurately. How do you see some of these announcements around affordable housing and focus on urban planning impacting the demand of the real estate sector? Because that's something that is really hitting the sector very, very badly over the last couple of years.
Thanks, Neeraj. And first of all, good evening to all the audience, and good evening to my co-panelist. So I want to first congratulate to the government of India for a very, very bold budget, I would say, because they've stayed away from a lot of populist measures, which a lot of us were expecting, frankly. And this kind of a budget in the middle of state elections is a bold move. So I want to congratulate the government for that. Coming to your specific question, the government has announced 48,000 crore of investment for completing approximately 80 lakh houses in the affordable segment under Prime Minister Awas Yojana. This is majorly focused on rural segment and people in the economically weaker section. So if we kind of take a step back and look at this particular scheme, this is a flagship scheme for the Prime Minister Modi, and this scheme is actually going delayed as per the original plan, which was rolled out by the Prime Minister in the earlier stint. So I think this injection of capital for this particular scheme is timely, and I think will help accelerate the execution of this scheme. But if you frankly ask me, will it have an impact on the affordable housing in urban segment, or for that matter, overall real estate sector or demand in the real estate sector? I am not sure, because this particular scheme is focused on very, very specific rural and economically weaker section, and the intent is very different. This may not have an intended impact on the affordable segment, which a lot of state governments are executing either individually or in partnership with the private players. So that I don't think will have any impact. But at the same time, I think very important, while direct measures are missing in this budget, which will give a direct boost to the real estate sector. But what Padma just talked about, the entire investment in infrastructure sector will have a lot of positive impact on real estate sector per se, and especially in residential real estate sector. So it will have twofold impact, Neeraj. As you rightly said, the demand was missing in this sector for last almost 4-5 years. But luckily, we've been observing that for the last 3 to 4 quarters, we've seen a very, very positive momentum in the demand sentiment. while the supply is not keeping pace with the demand, but demand sentiment is improving and people are finding for good quality homes, and people are looking to invest into good quality homes if the developer is stable and the projects are viable. Supply has not kept the pace for multiple reasons. One, there is an oversupply in the market, and second, we know a lot of developers has a lot of balance sheet related issues, and the access to debt is still missing, right? So these are the reasons which is impacting the supply side, but this also has a positive impact, because if the supply is low and demand is high, so essentially your inventory goes down, and once your inventory goes down, then the tendency of investing further into new launches will significantly go up. So all in all, I would say, while there is no direct boost for the real estate sector, but definitely there are a lot of other signals which will definitely give a push to the real estate sector, not only on the demand side, but also on the supply side in the longer run.
Right, Vikas. I couldn't agree with you more. And I think I just picked two key points from what you just said, and which are really critical. You talked about demand sentiment getting improving, from the perspective of overall sector, and also I think we still have the problem of lack of capital, right? And it could be because of various reasons. But again, if we can just move to Sumit here, just focusing on residential piece as of now. And Sumit, you've been interacting with a lot of institutional investors, right? While they have been reasonably open to look at commercial real estate, but certainly on the resi side there has been some sort of reluctance they've shown, right? So with some of these announcements, and I heard from Vikas and even Padma, there may not be any direct sort of a announcement impacting the sector as such, but the announcement around creating urban centers of excellence for urban planning, push around overall infrastructure. We also heard about reducing time relating to approvals, I think, which is a very painful area for the real estate life cycle. Do you think some of these steps will really try and convince the fence sitters, as we call them, to really look at resi side as an asset class to invest?
Okay, so thanks, Neeraj. And I am assuming that you're talking more from the standpoint of institutional investments
Yes.
and flows of funds coming into Resi. So at the very onset, I think echoing some of the themes which Padma touched upon, Vikas touched upon, that in spirit and in terms of theme of the budget, I think one thing that really stands out is consistency of the budget across sectors based on that India at 100 theme, which means that the FM has, I think, very well steered clear of all popular demands of most sectors, and instead chosen to put wheels beneath the economy and allowing sectors and their individual demand supply dynamics to kind of propel towards the next phase of growth. And the approach, quite honestly, to me, seems akin to giving the economy vitamins and nutrients for overall nourishment, rather than looking at steroid shots to boost any immediate problems that have been plaguing specific sectors. And let me know, there is no direct answer to your question. Let me be very upfront there, but let me try and address that in 2 or 3 different sections here. And if you were to look at what the government has done over the last 4 or 5 years, and that's where I think that whole cycle of reforms kicked in for real estate, where the focus was largely on fixing some of the trouble spots of the sector per se. And we saw RERA coming in. We saw the much talked about REIT framework coming into play, which I'm sure Arvind will touch upon at some point in time. And that dedicated fund which the government spoke about and successfully commercialized for completion of last mile stuck residential projects. The Swami Fund is what I'm referring to. And affordable housing also saw a range of measures coming in, one after the other, and subsequent announcements in every budget. So it's very clear that in that phase of reforms, the government was more focused on fixing some of those ills which quote unquote plague the industry. And what seems to me is that the priority for the next phase of growth for real estate for the government is to provide rather systemic support at structural levels, which will facilitate sustainable development rather than go after specific areas which can boost demand or supply. I mean, that's been one of my key takeaways. In fact, one of the pre-budget quotes and surveys, I pointed out that given the current health of the residential sector, maybe it's the right time for the government to think about creating a strategic roadmap for the next decade for real estate, rather than look at ad hoc measures which could spur or spoil demand or supply in the near term. So with that as a context, let me kind of take a little bit of a flashback and a step back on how that institutional investing environment has panned out in India. So if you look at that entire phase of 2005 to 2006, which saw flurry of foreign capital players and serious institutional investment come into the country, and that was a time where the investments that were coming in as pure equity investments. 2005 to about 2010, 11, maybe 12 is the period where we saw some serious investments come into the sector. And then suddenly, 2013, 14 onwards, the environment started turning, which was pretty much in line with the demand cycle of real estate as well. But that's the era where we saw equity getting completely knocked out and getting replaced by debt and structured debt. Availability of bank credit, institutional NBFC credit, and drying up very seriously for real estate on the whole. And most importantly, whatever equity was coming in largely for commercial, and that also nearly built out assets, and more pronounced in actually leased out assets. And that's the era where we saw that even for debt products, the return expectations for investors were hovering anywhere in the 18 to 22%, maybe even higher for a lot of those investments. And suddenly, real estate for residential, both in terms of quality of capital and number of transactions, was very seriously hit. I recall that I think from about 2.9 or $3 billion of flows for residential in 2015, the number completely dropped to about 300 odd million in 2020. And number of transactions also from about 75 to 80 a year fell to about single digits, or maybe about 10, 12 a year. But I think one of the key themes that stood out in that entire cycle was the risk aversion of investors, particularly for project development, which had a high execution risk. And that was, I think, a consistent theme across investment that we saw. And that's the reason, as I said, that most investments were in that time coming for built out and leased out commercial assets. So this was, that whole cycle of 2005 to 2020. But now, if you look at the current budget announcement, some of the themes that you touched upon, whether it is, setting up high-level committees for superior and better urban planning, digitization of land records, shortening approval cycles to fast-track projects. I think these are aimed at setting out a vision for providing a conducive ecosystem for institutional investment to come in, and that's a process, not something which will start showing in results straight away. But it is, I think, aimed at pushing the industry to actually think like an industry, rather than just chasing that tag of qualifying as an industry. And the results will likely play out in a longer period of time, because this is likely to create that, for example, planned urbanization for sustainable growth is something which is intrinsic to building investor confidence on sustainability of projects. And things like this will clearly improve sentiment from an investment perspective. Similarly, things like digitization of land records, that's been I think we've been hearing about it for a very, very long time. But if steps like this are actually put into motion and the implementation is fast-tracked, I think the results will start coming in faster. None of them will have direct bearing on the investment climate. But as I said, if the execution is right and the pace is swift, I think it is clearly a very positive step to build that sustainable investor confidence. And also, I think the overall approach appears to be aligning real estate to the new age economy here. And that's been the missing link. Real estate should not, with the growth and the multiplier effect that it offers to the economy, it has no reason to operate in silos and as an largely unorganized and a fragmented space versus where the overall economy is heading. So net, I think sustainability, governance, transparency are some clear implied or intended objectives of the government's announcements. How much of that will pan out in terms of immediate flow of investments? There's a question mark. But are these sizable? Can they create a sustainable equity investment climate in India? They will certainly aid to it. But I will probably just summarize by saying that, to my mind, the availability of credit and that improvement of the credit environment for real estate, particularly for residential, is more important to enable sustainable equity flows into the industry. Because as long as debt capital continues to fetch 18-20% returns, there is no motivation for equity to come in. So I think that's the piece which remains slightly unaddressed, but hopefully will play out along with the intended objectives of the FM in the coming months and years.
So thanks for this, Sumit. I hear you. I think you talked about the aversion still exists, but I guess you said the steps taken are in the right direction. But I would come back to you again on what could be the steroid, if we can use that word, to really propel some of these things in a slightly faster way. So from residential to let's switch gears towards commercial, and Arvind, if I can come to you now, you represent India's first publicly listed REIT, and I have got two questions for you. One is, what has been your experience of REIT in last couple of years when things remain a little uncertain, both around earnings and the valuation? And the second one is around the announcement of data centers being considered as part of the overall infrastructure status. Does it really help, and do we really see people or developers looking at this as a readable sort of a platform going forward? So Arvind.
Sure. Thanks, Neeraj. Good evening, everybody. And just to start off with, I think I echo almost everything what the other panelists said around the overall theme of the budget. But just not to repeat what they said, let me just straight dive into the question you asked, Neeraj, because there are two separate segments. Let me start with this whole REIT listing and where we are. It's been around a little less than 3 years since we got listed. But it's interesting to note that out of the 3 years, 2 years we have spent in the shadow of this pandemic, right? Where in the initial part of the pandemic, the whole existence of commercial real estate in a way was questioned because of work from home, et cetera, et cetera. So given this interesting 2 years, what we've seen, the way I would summarize it is in 2-3 forms. One, today, as we speak, there are around 3 REITs. So interestingly, 2 REITs got listed after us right in the middle of pandemic. So that kind of speaks about the strength of this product, even though we were going through the most difficult time for the sector per se, right? So, I mean, the reasons for that are many, but just to summarize in a minute, I think commercial real estate and, the whole concept of REIT has always been about stable asset class. The fact that, the entire sector was tested like no other time. And despite that, across the sector and across all the 3 REITs, when you look at it, the occupancy has reduced, but it's reduced ranging between 4 to 6%. Most of us are still having occupancy ranging from 85 to 87%, which basically means the underlying strength about commercial real estate in India, specifically about REITs, continue to be there. And we believe that this is a product which will only grow as we speak. So at this stage, let me just give you some numbers and why we believe we are still at a very nascent stage of the growth story. When you look at India per se, right, the 3 listed REITs are around 60 to 65 million square feet, around $8 billion of asset value. overall commercial real estate grade A space in India is anywhere between 650 to 700 million square feet. So effectively, you're talking about 10% of grade A commercial real estate, which is today listed. So there is a lot more potential for the other grade A commercial space to come into the REIT product. That's number one. Number two, when you compare this to global, right? Globally, REITs are a completely evolved asset class. I think across the globe, public REITs are around $2.3 trillion of assets which are listed. Just in the US, around 65% of the the total real estate is in listed form. So that's massive numbers you're talking about. And the last part is today we are still talking about only commercial real estate, which is in listed REIT form. But from a concept perspective, globally, there are very, very different asset classes which have REITed their assets, if I can say that, which include hospitality, which is hotels, just hospitals itself, residential, industrial warehousing, malls. So when you look at all these asset class and the potential growth which is available in India, I think it's a massive growth story which you can foresee coming in the years ahead. And just to pick up a point which Sumit spoke about, the cost of capital. When you look at the cost of capital for us as Embassy REIT, and specifically the point which Sumit spoke about, the debt capital, our REIT specifically, we have 11,500 crore debt book. Right. Of course, we are still lowly levered at around 24-25% of asset value, but our weighted average cost of capital today is 6.6%. Of course, we have benefited from the massive reduction in interest rates, but we've also benefited from the fact that lenders see this AAA asset class as a very, very stable asset class, and we've actually benefited more because while there is massive liquidity in the system, the banking system and across, they have been chasing more quality assets during this difficult time. So what that means is the products which have got listed are actual top class quality. So there's more capital chasing us. And just when you look at growth, right? I mean, commercial real estate, you can talk about, cap rates of 7.5%, 8%. Previously, you could never think about borrowing debt to acquire assets, right? Because the debt was 9, 10, 11, 12. Today, you can do a debt-based acquisition because cap rates are still in the range of 7.5, 8. Cap rates have not reduced in line with the reduction in interest rates. So I think we are in a pretty interesting stage. Of course, we do realize that as globally rates are expected to increase, India might also increase. But of course, I would be personally keen to see how RBI plays out to kind of support the overall capex needs which the finance minister has laid out. With that, just jumping on to the next segment, Neeraj, while we as Embassy REIT don't have any data centers, but just to give you some perspective, because we've done quite a bit of study on this, I think, let me split it into three parts. First, where are we on data centers, right? It's still at a very nascent stage in India, but there's massive potential to grow. I think based on a study, it's expected to grow by 30 to 35% CAGR in the next few years. Now, why is that happening? It's largely because of the massive growth in the tech sector, the large global capitals which are coming and setting up shop here, as well as the massive expansion of the startup ecosystem, especially the fintech e-commerce companies, right? So when you look at all of this, we believe that there's a lot of potential for growth in the data centers. But having said that, what does it take to set up data centers, right? It basically requires a lot of resources. What I mean by that is, one, you of course need land at reasonable price. So you need to have sufficient regulatory availability or the regulatory support to ensure that you're buying land at the right time at the right price. The second important piece is, when you look at the construction cost to set up a data center, right, it's almost 7 times the capex needs of a commercial real estate space. It requires around 25,000 square feet rupees cost to set up just data centers. And third is, of course, it requires uninterrupted power supply. It actually requires dual line as a backup to ensure that there is business continuity if something goes wrong. So taking all of this together, how does this infra sector categorization help? Largely, it helps effectively in 2 ways. One, just because it's categorized as infra, there is wider access to capital, right? There are a lot more people who can pump in money. And secondly, because again, it's infra, some of these capital adequacy norms which are there for a real estate sector are not there. It's much more lighter. So basically what it means, it's availability of capital, and second, availability of capital at a much cheaper cost. So taken together, I think this move of categorizing it as a infra will definitely help data centers as a sector. And we believe, as I said previously, data centers itself can be a category of REITable assets. And of course, there are a few other commercial real estate players who take data centers as a second segment of their development growth. So both are possible. So overall, I think this is a very, very positive move as we see these data centers evolve in India.
Right. No, thanks, Arvind. So what I gather from you is that REIT story is still very much alive and relevant for India. We've hardly seen any REITs, and I think India needs to look beyond the traditional offices, look at other asset class as well. And also, I think that the data center, announcement is also got a huge potential. Given, but yes, you talked about challenges also. But I think one sort of challenge is being eased by the government on the capital side. But I'm sure, and I can move to now Mr. Alan, who runs the SEZ. I'm sure the other challenge of land and all can really be supported by Mr. Alan. And Mr. Alan, so we heard about a very interesting announcement by the FM on the SEZ law, and I know you've been focusing on the SEZ matter for quite a while, working very closely on the policy side. So if you could just help us understand this announcement a little better, and what really changed the government's mind to look at revamping the SEZ Act.
Well, at the outset, first, Neeraj, thank you very much for inviting me for this panel discussion. It's really a pleasure to be amidst such illustrious panelists. So, let me just take you back. You've known the Baba Kalyani report was submitted in 2018 on the SEZs and the reforms that were required to take place. But that was, all on a back burner. And we have seen, even before the pandemic, we had the US-China trade war, and we've seen supply chains relocating. And during the pandemic, of course, since 2020, the supply chain relocation has been at a much faster clip. Now, when you really look at all the supply chains relocating, very few of them have really come into India, despite PLI and all other schemes. And if you really look at the data, India, exports, if I take off petroleum products and I take off the gem and jewelry, typical manufactured products, we export something in the order of 260 billion. Now, I'm not an economist or a trained accountant like all of you, but if I look at the exports of China, it is 2.6 trillion, which is 10 times what we are doing. And China is doing 2.6 trillion without petroleum products and without gem and jewelry exports. Now, the point I'm trying to make is just look at the scale of the market out there and look at what we are tapping into. Now, look at the import side. On the import side, India has actually has imported the year gone by more than we imported before the Doklam crisis. So despite all the noise we've been making, our imports have actually increased. And most of the imports have been in, HS codes 84 to 97, which is typically engineering, electronics, and manufactured goods. And if you look at the volume that we've been importing from China, it's close to around 70 billion. And if you again look at the imports which are coming in through Hong Kong and through ASEAN countries, which in my mind, when I look at the import-export matching data, these are nothing but Chinese surrogates. There's another matching import of around 65 to 70 billion that's coming in. So almost around 140 billion is what we are importing from China, which translates to 50% of our import bill. I mean, when I say the import bill, this is without petroleum products and without precious metals, HS71, for manufactured goods. Now, India's dependence on China is 50%, whereas China's dependence on India as an export market is less than 5%. Now, when you really look at the kind of factories you are trying to attract into India, you are only able to attract those factories, which are looking at the Indian domestic market for consumption, because India has 1.3 billion people. So there is a market of some size. So only such are those manufacturers who are looking at the domestic Indian market are coming here to set up factories. So for every $1 that is a potential that's coming into India for Indian DTA, $20, which is the global market size, is not coming into India. That's going to Vietnam, that's going to Thailand, it's going into Mexico and wherever else. And even into India, many of these factories are not coming into India because they prefer to come into access Indian markets of the ASEAN and the FTA trade agreement countries. I mean, you probably all know that Colombo port is going in for a massive expansion with Chinese investor support. Now, I am very clear in my mind that this Colombo port expansion is not going to be attracting Japanese or Germans or Americans to set up factories, but these are going to be Chinese factories, including Chinese labor, and they will be accessing Indian DTA through the Indo-Lanka Free Trade Accords. Now, we can see all these things happening. We can see ourselves getting swamped by these agreements and by these products coming in, because we have not done enough to make Indian manufacturing attractive. Restrictions, tariff barriers, non-tariff barriers, this is not the way we can make India attractive as a manufacturing destination. India has got to become attractive for a global manufacturing destination. And we've been pushing the government that we are not seeking, to achieve pole positions as becoming globally #1 in petroleum products or in gem and jewelry. That's not where we have our strengths, but our strengths lie in plain manufacturing of vanilla products, manufacturing of technology products. And now I'm seeing reports that the EV vehicle manufacturing has a potential of $2.1 trillion as compared to mobile phone manufacturing, which was 600 billion. Now, mobile telephony, most of these EMS companies are moving away from mobile telephony because that's no longer considered high tech. It's today low to medium tech. And they're all looking at getting into the EV space. We need to be getting ready for that. And I'm really grateful, that the FM has, for the first time in the budget speech, taken cognizance that SEZ version 2.0 is now due for a rollout. And the Department of Commerce has been actively working on this process. Now, what they're really looking at, just to give you some insight, what they're really looking at is making these SEZs as while being physically in India, but giving you a similar platform as if you are in Vietnam or in Thailand, where everything that comes into these SEZs will be tariff-free because you're outside the customs territory of India. And whatever products are manufactured in these SEZs and sold into the Indian DTA will be subject to lower tariff rates. At the present, all these products in an SEZ which are manufactured and sold into Indian DTA are subject to a full tariff, which means including the value addition and the local components that are used in the manufacture of this product are all subject to tariffs. And it becomes cheaper to import the same product from Vietnam or in, Thailand under the FTA than to manufacture the same product in Noida or in Chennai. And that's what many of these foreign companies are finding. This is becoming a challenge. So now what we are saying is make India into a manufacturing hub, not just for Indian DTA, but for the entire world. These global supply chains must move to India, not just for Indian markets, but with their entire global order books. Technology, plant machinery, and skills is one thing which they can bring in, but we want to attract their order books. We want to get their $2.6 trillion order book to come into India one way or the other and supply that 100 billion into India and balance 2.5 trillion. I mean, I'm just giving an extreme scenario to make a point. To export the $2.5 trillion from India. And, many of these companies have the potential and the desire to move to India because of political reasons, because of cost of manufacture and so many other changes happening within China itself, that India is definitely becoming an attractive place for manufacturing. And I think the SEZ format is a good place for them to make this beginning. And even the Prime Minister has been talking about the Atmanirbhar Bharat. Yes. And he's mentioned about the special economic zones as being a key component in being able to make this Make in India story a big success. And it's in line with all of these policy statements in the past and currently, that the SEZ format is undergoing a change, and it's undergoing a change for the better. And I think, foreign investors and foreign factories and manufacturers are really looking for, they're looking for a plug and play environment when they come into India. And all of these changes which are coming in the SEZ policy will enable investors like Arvind, like Sumit, like Vikas and people like that to invest into industrial assets where they can provide plug and play environment and lease rentals, like in an office building is a lease rental model. The same thing will happen with industrial assets. It will become a lease rental model because many of these foreign companies do not want to come in and invest in land for 99-year leases and make factories and create real estate. They want to be asset light. They want to pay a monthly lease rental, and I think this is going to result in what I would consider as Uberization of the entire business model. Investors will invest in real estate, manufacturers will invest into technology and into marketing, and probably machinery companies will be investing into the high-tech machines, setting up the fabs. It's going to be like the aircraft industry where airlines don't necessarily have to own these aircraft, they can lease them. And machinery manufacturers who have the expertise in machinery will invest in high-tech plant and machinery where multiple users will be able to access these machines on a pay and use basis. So that's the kind of ecosystem that is eventually going to be panning out in the next 5 to 10 years. And I think it's very interesting for Indian manufacturing, and the reforms of SEZ 2.0 is a step in that direction. So I'm actually very excited about this entire story.
No, absolutely, sir. I think it sounds very, very promising. And sir, any idea when do we see this fine print coming, for all of us to look at?
Well, I think in para 148, the FM herself mentioned that she wants to, have all this digital connectivity and all this rollout happening by September 2022. So I take that as an the outer boundary time limit which she has set herself in Parliament. And from what I've known from people who are working on this entire process, it's actually being fast tracked. And I think we should see this rollout before September 22. Maybe in the monsoon session of Parliament, we should see some action on this.
Wonderful. Arvind, I know you also been tracking SEZ. Anything you want to add to, what we heard from Mr. Nalan?
No, honestly, Mr. Ralan has covered it very, very comprehensively. But just my 2 bits on this is purely looking at it from a commercial real estate, right? We do own a lot of SEZ space, but the demand for SEZs are going away, right? But the laws are pretty archaic where you talk about, it's like a separate island by itself. SEZ, non-SEZs can't coexist. So basically, as Mr. Ralan said, I think there's been quite a bit of industry representation, and what is really positive is the way they have taken all the points what we've mentioned. And we've just made some simple points like let there be coexistence of units between SEZ and non-SEZ, right? Number 1. Number 2, allow for rupee billing. Make the whole denotification process a simple process. Today, if I were to go and denotify, it's a 1-year process spread across some 5 to 10 ministry bodies. We have said SEZ should be a single window clearance, right? So you make it a single window denotification process. So what's really noteworthy is the fact that they didn't do any repair job. They've clearly said we will come out with a new act. So we're really hoping that this will be a completely new comprehensive act, which takes into account all the facts which Mr. Allan said for the new age India. So pretty positive about it.
I'll just like to add to this that, especially with reference to the IT SEZs, because the business model with work from home and a lot of changes are happening, and supplies into DTA, because the SEZ Act came out in 2005, and the GST came out much later. So the GST is a more contemporary economic legislation, far more contemporary than the SEZ. And in the SEZ, we still talk about supply of the sale of goods and services, whereas the GST talks about supply of goods and services. So in the SEZ Act, unfortunately, back then they had in the SEZ Act itself that services must be in free foreign currency. Now we've been pushing the government, and the government has taken a note of this. In the new act, hopefully these kind of onerous conditions will be removed, because not only they are not WTO compliant, but they also are, quite deal breakers for investors and for units operating there. Because once services can be provided in rupee payment and there's no NFE compliance, then even the existing SEZ buildings clients can operate in them, not with any export obligation, but even do 100% DT and do rupee building. And whenever there's an export opportunity, they can look outbound. So business today, government is trying to understand that business today cannot be, planned on an Excel sheet where somebody can commit how much is going to be DTA, how much is going to be export, because business today is very dynamic.
Yes.
You could suddenly see the situation from domestic to exports turning around very, very rapidly, and vice versa. But the point is, there is business out there to be had, and business should come into India, and economic activity and job creation should come into India, and revenues should continue to grow. So we should not tie ourselves up in our own knots, which do not create jobs, which do not impact revenue. And therefore, I think this rupee billing for service sector SEZs will be a big change for them.
Right, right. So we move on to the next section of our discussion, and I thought it'll also good to reflect back and see where industry obviously came out with certain set of expectations from the budget. Yes, some of them have been considered and met, but it'll be good to see what are the couple of key misses you felt the FM could have considered for the sector. Maybe Padma, if we can start from you from the infrastructure sector perspective, then moving on to Vikas and then Sumit and then to others.
Yeah, Neeraj, so I think there are two things, according to me, are misses. One is, the lack of laying down in black and white the institutional mechanism of how these things will work, right? So last budget did, take up some of those, like, development finance institution, creation, etc., was very well spelled out last time. But this time we don't see any of these things. Then how, but they are expecting all the ministries to work together and look at, readiness of India 100. But then how is it going to be? Who's going to be the first mover is something very, very grossly missing in the budget. I think that should have been addressed. The second thing is, pretty much we expected many other sectors to get the infrastructure status. But then according it to something like a data center, to me, I'm not very sure about it, purely from the perspective of the output that would come out, right? So data-led decision making, are we really following that today? We don't, right? And I can give, pick a feather from the smart cities that we have done. So many command and control centers which are effectively acting as data centers got set up. What are we doing with those data today? Are we able to use that data and look at creating some kind of a roadmap for us for future benefits? That is grossly missing. We are not doing that. We don't have capabilities within the municipality system to actually look at those things and take it forward. So I think, probably, maybe it will come in the future, but at least here it was missing, according to me. Yeah,
Okay,
Neeraj.
okay, fair point. Vikas, from the perspective of the real estate, I know there was a long list of demand which has gone to the government, but any two top in your perspective was
Yeah, so I look at it more from a stakeholder's perspective, Neeraj. So if you allow me, I'll touch upon three topics.
sure.
One, we've already discussed when Sumit was talking about the access to the debt capital. I think this is one issue which is impacting the real estate industry significantly because it's hugely capital intensive and reliance on debt is massive. But government has to figure a way out to solve this problem because the industry or the sector is struggling with this for almost 3-4 years since that NBFC crisis happened. And while I agree with Sumit that the government should look at some kind of a roadmap for the next 10 years for real estate sector, because at the end of the day, this is contributing 7 to 8% of GDP, the largest second largest employment generator. But I slightly disagree with Sumit that the tag of industry, I think that is needed. So that is a miss from my perspective. The government, it's a high time now, should recognize real estate as an industry. And that's where a lot of things will start falling in place because access to debt at a lower rate and a lot of some of these things like roadmap creation and all these things will fall in place. The second miss, which I feel, while the FM has touched upon this topic, that single window clearance or a faster clearance of approvals, but I don't know for what reason they've specifically said the focus will be on affordable housing and economically weaker section. This is an inefficiency in the system, and when we are trying to remove inefficiencies, it needs to be removed for the whole sector. Why only for a particular segment? Are we saying that inefficiency will remain there for the real estate which is not falling in affordable segment? I frankly very disappointed with that. The third piece, from the consumer perspective, which I feel is missing, I think we've been talking about it, one nation, one tax. It's a high time the government should think of subsuming stamp duty under GST.
Right. Fair points raised, Vikas. Sumit, what do you think in your perspective?
So I'll
could
make
have
it
been
simple, Neeraj. I think on the whole, vitamins for nourishment are good for now. I think the sector is fairly well positioned to capitalize on all the good work that has happened over the last few years. But just to very simply put, and also back to Vikas's point, clarifying so that my earlier comment is not misunderstood. What I meant there was that maybe the government is wanting a behavioral change for the industry to start behaving like an industry. But I think from a capital availability standpoint, from debt availability standpoint, that infrastructure and industry tag is extremely important. I think apart from opening a new funnel of capital, which is currently not available to the sector, it also creates a very significant perception shift, takes it out of the red list, touch me not list from a lot of institutional capital providers. And from a more near-term perspective, I thought what the government could have taken a little more cognizance of is a little bit of a proactive approach. We are seeing very significant headwinds of a upward cycle in interest rates. And we all know that the sector is very, very vulnerable and impacted by some of those movements. So whilst all sectors have come out with their demands of rationalization of tax and tax reduction, but I think some proactive move this year on some of those deductions could have possibly given us some buffer for any headwinds that may hit us in this year.
right. Absolutely. Arvind, from your perspective of commercial segment, I believe there were certain things which were also very actively pushed through the government corridors. Are you satisfied, or
I think I would say two key messages. Of course, every year, all of us do send long list of representations, but we do know what are the top two items which we look for, right? I think from our point of view, if I can combine REIT and InvITs together, one of the key, things which we're looking for was, while they allowed FPIs to participate in debt securities of REIT and InvITs very recently, the issue is under one particular section, 194 LD, there's a concessional withholding tax rate of 5%, but that's available only to listed companies. Is not available to listed trusts, right? When this section came into existence, there were no trusts. So it was just a logical extension of this section. As you look, forget about REITs for a second, just from a government point of view, while they're looking at InvIT as a mode of raising capital, even Mr. Nitin Gadkari has said in multiple statements that he would like to raise a lot of money through InvITs. If you want foreign capital to come in, this has to be rationalized. You can't expect foreign money through FPIs to come in when there's a 20% withholding tax. I think that is something which we were pretty keen that will see the light of the day, but didn't happen. Second is more specifically for our unit holders, again, both for REITs and InvITs. Unfortunately, the unit holders, for it to be called as a long-term capital gain, the asset holding period is 36 months versus 12 months for listed equities. I mean, again, we believe that it's just a natural extension which is required, that units should be classified similar to equity shares. We did see some articles come before budget that's something which is being looked at pretty carefully. So we were hopeful that will come through, but unfortunately it didn't come through. I think these are the two key misses from our point of view.
No, I completely agree. And finally, from your side, Mr. Anand, anything you believe should have been?
Well, from our side, we've been representing with the government is to extend the sunset clause, especially for the units and the developers on the SEZ. So the sunset clause was brought in from 30th of March 2020 for all units that had been approved before 31st of March 2020, and they were expected to go live by 31st of December 2020. So we've been saying that in view of this pandemic, the sunset clause should have been extended at least till the pandemic is not officially declared as no longer being a pandemic. This sunset clause should keep getting extended. And that has not found favor with the government. So that's been a bit of a disappointment.
Right, right. No, I wish we could continue like this. I mean, it's very hard to get such such experts together in one panel. But again, I'm conscious of time, and I guess we are on time. And looks difficult to take any further questions from the audience. But I would like to thank all of you for sharing your perspective in a very frank manner, and also sharing certain very pertinent points which are relevant. And I'm sure some of these things, while this government doesn't really wait for the budget, and I'm sure some of these things might hit the right corridors very soon, and we get some positive announcements in months to come. So thank you all of you.